The Federal Reserve has entered into panic mode because it cannot control the situation of both inflation, employment, and the fiscal disaster of the United States. The decision to cut rates comes as literally the bailout of the government. It has nothing to do with the state of the economy, certainly nothing to do with employment. It has everything to do with its impossibility of normalizing in an environment in which the government continues to increase its imbalances. Let's talk about normalization. This is the Federal Reserve's balance sheet in the past years. If you have seen such a massive increase in the balance sheet, what you can also see is that every time that they try to normalize a little bit and reduce the balance sheet, immediately the fiscal disaster of the government makes them take emergency measures and therefore increase the balance sheet yet again. A modest decline of the balance sheet after a $9 trillion increase is simply the realization of the fact that the government is going to continue to destroy the possibility of maintaining the purchasing power of the currency. At the end of the day, the Federal Reserve doesn't print money because they are stupid or reckless, but because the Treasury is simply massively increasing its imbalances. So the first thing that we see is that the so-called process of normalization is not normalization. Let's go to the next graph because we are still in a very bullish mode from markets. Markets, according to this graph, thanks to Jerome Blockland, who you must follow, is discounting at least 5 more rate cuts. So, lack of normalization and a lot of rate cuts are there. Why? What is the Fed doing? What the Fed is doing is literally bailing out the government, because what they saw was, number one, that the 2-year government bond yield rose to 5%, and immediately the Fed already panicked and started to slow down its process of the previous normalization that I mentioned. It started to slow down the process of reduction of the balance sheet. That was the first sign of panic. Sign of panic number 2. Rate cut of 50 basis points in an environment in which they say that the economy is solid, that there is absolutely, and I quote, no risk of recession or downturn, and in which they see that the employment outlook is very robust. And they cut rates dramatically. Furthermore, they see no impact from the rate hikes in the investment growth, etc., of the economy. What we have seen is that the entire burden of policy normalization of the rate hikes has fallen on businesses and on families. And what we see is that this rate cut is not going to go straight to your pocket, improving your ability to make ends meet. It's going to go straight to bail out the government. Let's go to the next graph. In this next graph, what we see, thanks to Bloomberg, is what the Fed has said. They're worried about the labor market. Oh, they should be worried about the labor market, increasing public jobs by 50,000 a month and not reaching the levels of labor participation rate or employment to population rate in 2024 after such a massive stimulus. Very well below the levels of 2019 shows that the labor market is much weaker than it seems. The unemployment rate at 3-year highs. Employment to population and the labor participation rate below the 2019 levels, and real wages in negative territory. They should be worried, but that's not what they're worried about. What they're worried about is what we're going to see next. Let's go to the next graph, and what we see is what the Fed is really concerned about. Luke Groman, good friend of ours, was posting this graph, phenomenal graph, which shows the enormous debt maturities of the government. And the government simply cannot tolerate high rates. Therefore, the Fed needs to cut rates in order to bail out this enormous level of United States debt maturities. The increase in spending, the monster deficit, the absolutely incredible level of increase in debt that we are going to see until 2034. The Treasury itself expects 16 trillion more of debt, plus the Kamala Harris plan, which will add another 2.5 trillion to the national debt. That's very, very dangerous. That's why the Fed has panicked. Let's go to the next graph, which shows us why there is reasons to panic even more. Good friend of ours, Luke Groman, also posted this graph, and David Summers showed it as well. Incredible. Now, this is the increase in the national debt and the increase in holdings of foreign holders of treasury bills. You see the difference? The enormous increase in national debt, while foreign buyers are not piling into treasuries. Actually, they're doing the opposite. They're slightly reducing their holdings of treasuries. The Japanese, the Chinese are not buying more treasuries. They don't want more US debt because the confidence in the fiscal stability of the United States is falling down. And this means that the entire burden of the massive increase of debt is going to fall on the shoulders of American citizens via persistent inflation, loss of purchasing power of the currency, lower growth, lower employment, and lower real wages. When the government tells you that they're going to give you things for free, what they give you for free is inflation, the hidden tax. Let's go to the next graph, which shows us how dangerous the fiscal situation of the United States is. Defense spending is enormous. Everybody knows that defense spending in the United States is enormous. Well, interest expense is now going to reach the levels of defense spending and is eating away the budget. Why should you be worried about this? Those that say that debt doesn't matter if the cost of debt is manageable lie to you. Because it's not just the cost of debt, but the increase in debt what matters. And when debt increases as fast as it does, and in the United States, for every dollar of debt, you get less than 0.5 of GDP, $1 of debt, less than 0.5 of GDP, that means that you are literally destroying the economy from the government. That is what they're doing. That is literally what they're doing. And this figure of higher interest expenses than the defense budget is only going to increase even if rate cuts are implemented and even if the cost of debt is low. Why do we know that? Japan. Japan spends almost 25% of its budget in interest expenses, even with very low cost of debt and very low bond yields. Ultimately, when the Federal Reserve cuts rates and bails out the government, it is a massive transfer of wealth from the private sector to the public sector, making government more bloated than ever and making that enormous transfer of wealth another significant problem for the real economy, which is the crowding out. Is that the government is absorbing the demand and the supply of credit and is absorbing balance sheet from commercial banks, while it is more and more difficult for families and for businesses to finance their activities. That's why this so-called social policy is anti-social. It's completely negative. What they are actually doing is eroding the ability of the middle class to survive and of small businesses to thrive. That is what they're doing via crowding out, persistent inflation, higher taxation, which is also what's going to come, and the fiscal imprudence of the government. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel. Like my videos, leave your comments below, and keep defending freedom. Thank you very much.